Hi, I'm Alice.
And I'm Wayne.
And welcome to our rabbit hole.
So today is a very special day. It's tax day!
Well, actually, taxes are really confusing, and sometimes I think maybe our pharmacokinetics class in pharmacy school was more like a piece of cake in comparison. So today we are going to debunk 4 myths and misconceptions about taxes, and we're going to share with you what we learned along the way.
So just a disclaimer, we are not accountants or tax advisors or professionals, and this is for informational purposes only. Please don't sue us. So tax myth number 1. So something I've heard is when I move up to a tax bracket, all my money will be taxed higher. And in general, we are in a progressive tax system, so the more money you earn, the more taxes you end up paying. However, that doesn't mean all your taxes being taxed at that same rate. We have 7 different tax brackets in the United States with 7 different marginal tax rates.
Yeah, and so with Wayne and I, we make between $168,000 to $321,000 combined. So we are at the 24% tax bracket. However, not our entire income is being taxed at 24%. The first $19,000 and $400, we are actually being taxed at a 10% rate.
So you won't be paying the extra tax amount until it's the income over that tax bracket. So while no one likes paying taxes, it's also a good thing to be paying taxes because it means you're making some of that money.
So you should still do OT, Wayne.
I can't do OT on salary. However, with that said, understanding the tax system allows for you to take advantage of the tax breaks that lower your effective tax rate, which is how actually a lot of wealthy people keep a lot more of their money despite making a lot more money.
Tax myth number 2. So we thought that we would get penalized if we don't completely finish filing our taxes by April 15th. So last year, our accountant was super busy and actually had to file an extension for us. At that time, we were both a little bit worried because we thought that IRS would come knocking on our door and just taking us in. However, what we learned is that we could actually not get penalized. And what you have to do is, as long as you file an extension and make your tax payment by April 15th, you won't get penalized. Well, how are you supposed to make a tax payment to the IRS if you didn't finish filing your taxes? What we learned is that you just have to submit an estimated tax payment to the government.
So filing an extension gives you or your accountant until October 15th to submit all the tax documents. There is no penalty for filing for an extension, but just to re-emphasize, it does not extend the time to pay the balance due. So currently, with the whole Roni situation, the tax deadline has been extended to July 15th of 2020. Now, there will be no additional interest or penalty regardless of the amount owed as long as you pay by July 15th.
So yes, so if you are expecting to getting a tax refund, we really recommend you to finish filing your taxes as soon as possible. However, if you think you're going to have a balance that is owed and you have to make a tax payment, then maybe you might want to postpone filing your taxes and hold on to the money during this crisis. Tax myth number 3. Married couples pay less taxes. So this is not always the case. You know, I originally thought that when Wayne and I got married, we would actually pay less taxes. But then Wayne started to tell me all about these marriage penalties. And so we actually almost didn't get married on paper, like this close. So before 2017, there were actually some couples that were actually paying more taxes when their combined income pushed them to a higher tax bracket.
And although the Tax Cuts and Jobs Act of 2017 removed that discrepancy that was embedded in those tax brackets, there is still a marriage penalty that's hidden in the rules.
As a married couple, when we itemize, we can now only deduct up to $10,000 for our state and local taxes, also known as SALT. Versus if we were still single, as in if we didn't get married, then we would actually still be able to deduct $10,000 in state and local taxes individually. That means that we can deduct up to $20,000 combined.
So in the end, by getting married, we lost $10,000 worth of deductions for the state and local taxes. That could have been a trip to Hawaii. So guys, if you really want to get married, please understand the tax implications, because you must love her more than money itself. You must truly, truly love her.
Tax myth number 4. You should always file married joint. Not always. So there are actually 3 scenarios that you might actually consider filing married separate. So when both spouses are actually high income earners and are both working, they are sometimes more likely to pay an alternative minimum tax.
So what is alternative minimum tax? It's a separate tax rule in addition to the regular income tax rules. So as if it wasn't complicated enough, they have another rule on top. So in the 1960s, there were wealthy people that were making over $200,000, but were paying zero in taxes. So in 1969, the government designed the alternative minimum tax to keep those people from exploiting all these deductions to avoid paying taxes completely. However, Congress hasn't really adjusted the AMT for inflation, and nowadays even people in the middle class can potentially trigger this alternative minimum tax. And with the alternative minimum tax, it rules out a bunch of deductions that people can normally take, and then it is compared to the taxes owed from the regular income tax rules, and then they'll choose the higher number. So basically, they want to take their fair share, or just their share. Now, there are so many different situations and scenarios which will affect which tax is used, so we do recommend you to ask your accountant.
And so another example when filing separate is more beneficial is when one spouse is trying to deduct their medical expenses. So, medical and dental expenses, in order to deduct those, they have to be more than 7.5% of your adjusted gross income. So, if you and your spouse have a joint income that is really high, it might be harder to meet this criteria so that you can deduct the medical expenses.
And then the third example in which maybe filing separate will be better is when one spouse has federal student loans and might be making significantly less. So in this scenario, it may be more advantageous to actually file separately, especially if you are on an income-based loan repayment plan. That way, the required monthly student loan payments can be smaller.
So there you have it, 4 myths and misconceptions that we had and that we learned about.
So the longer we work, the better we really want to understand these tax rules so that we can keep more of our money. So at the end of the day, it's really not about how much you make, it's also about how much you keep. And really, that's why we're learning and about all these rules. Now, have you filed your taxes yet? What misconceptions or myths did you hear about taxes?
So smash the like button and comment down below. Also subscribe to our channel and to click the notification button so that you know when we have our newest video.
Smash it!